Scottsdale office. I hope everyone's doing well. We thank you in advance for joining us on the call. I am so excited. I have Brad Shepard. He's an amazing partner of ours, and he's over at One America. He'll be talking about a very popular topic, especially I see these numbers that we've got registration. A lot of people have wrote me asking for the recording already, but using qualified dollars to fund your LTC. We will also touch a little bit on the Secure Act, which I know is top of mind for everyone. So little housekeeping. If you have any questions, please do write them into your dashboard there, and I will make sure that we get them to Brad at the end of the presentation. I don't want to take too much more of your time, so I'll give it to you, Brad.
Well, thank you, Allie, and of course, thank you so much to the Core Marketing Group team. You're a wonderful, wonderful partner, and so ditto, right back at you. And to have these types of opportunities to bring some of this information and some ideas, to your trusted relationships is something that I'm very, very grateful for. So yes, Allie set it up perfectly, and we will be talking about the opportunities to use qualified dollars to fund a long-term care plan. And then you'll see at the end, I will tie all this up into a nice little bow as it relates to the Secure Act, and in particular, a provision related to inherited IRAs. So why don't we just go ahead and get started? And Allie, if you would just confirm that on your end, you do see my slides moving forward, and that gives me the 20 seconds that I need so that everybody can read my disclosure slide. What do you think?
I see it clearly. Thank you.
Yeah, we like to have fun with the compliance disclosure slide. So why don't we just
no
go
one ever
right
puts fun in compliance. Nobody ever puts fun in sentence together, Brad.
Never. So everyone read every word. So here we go. I do have to, of course, do a bit of a shameless plug here for the company that I represent, which is One America. And some of you may be familiar, some of you may not, but I'm highlighting or spotlighting, as we say on the screen right now for you. That building is actually our building in Indianapolis. So we are headquartered in downtown Indianapolis. We are a mutual holding company, as you can see on the right-hand side. We are a mutual holding company, and what that really means when it comes to the most important people here is the policyholders, is that during any financial cycle, there's going to be storms that we have to weather, right? Ups and downs. I mean, we've learned that just in the last couple of weeks with some of the volatility in the markets due to unforeseen circumstances. So insurance companies, of course, the public ones have to be very prudent in hitting certain profits on a quarterly basis, whereas the mutual companies, they don't trade stock like that. So therefore, all of their decisions are made on behalf of the policy holder. And so we're also very proud of our financial strength, as you see I'm highlighting at the top of the screen as well. So we have top shelf financial ratings with AM Best A+, S&P AA-, and also very proud of the Comdex score of 95. And then finally, we were first to market with these, what we're calling asset-based long-term care products. The first ones were released back in 1988, and that was here at One America. Now, many of you may know the name Golden Rule. We did acquire the Golden Rule book of business, and so you have all of that intellectual data, so to speak, claims tested, times tested, underwriting tested with these solutions that's all bundled into what we have to offer today. So that was my plug on One America, so we can just move right past that. And for those of you that are watching my screen, I encourage this. So you'll see there's a little button that you can take a screenshot. Don't worry, take a screenshot, have fun with it, or take out your smartphone, take a picture of the screen, whatever you think is best. If you remember this slide and this slide only, this tells the entire story of our solutions at One America. Now, we will spend most of the time on using qualified dollars, but I want to take a minute or two and help you understand that we do a lot more than just using qualified dollars for long-term care. So let's start at the beginning. On the left-hand side of the screen, you will see that this is what we call the base policy. And that base policy, I like to use layman's terms, so that's really the client's money. And the client's money is in either a life insurance contract, we call that asset care, or it's in an annuity contract, and we call that our annuity care product line. And at the bottom, which I'm highlighting now, those are all the different ways that someone could fund one of these plans. And so we have, like everyone else has, we have big old-fashioned single premium that's just considered cash or cash equivalents. We can use recurring premium, pay to 95, which they call life pay, or a limited pay option like a 5 or a 10 or a 20 pay. We can, just like everyone else, use 1035 exchange opportunities, whether that's in an existing annuity or life contract. You can be creative and turn on income riders, or use things like immediate annuities or deferred annuities. And finally, what we're going to focus on is that qualified money approach. Now, the rule number one, because remember, not a person on earth is going to put a dime into any of these products at all, because they're going to get the best death benefit ever, or they're going to get the highest interest crediting rate. What they're putting their dollars into this for is one purpose, essentially, for the purpose of long-term care planning. Now, there can be some ancillary benefits, some tax advantages, and some overall strategies, which I'll talk about. But essentially, most people do it for one reason. I like to call that, let's keep the main thing, and that's long-term care. So when they need long-term care, if they need care, we're just accelerating the benefits of the base policy. That's it. And then, now at the time of buying the contract, if they want to have additional leverage beyond their base policy, if that runs out, we have what's called continuation of benefits rider, or COB rider. And that comes in the form of either a limited bucket or the one that we actually sell the most of, and that is unlimited benefits. So of all the riders that people buy, 80% of them are our lifetime or unlimited LTC benefits. We're the only carrier that offers that in this space. Now that rider is not free. It's being paid for in some way, shape, or form, and we can do that in all types of ways: single premium, recurring premium, or even as a part of the contract, which I can show you as well. Now, finally, on this slide, keep in mind that this rider benefit is filed as what they call tax qualified long-term care benefits under IRC code 7702B. What does that mean? It just simply means that any benefits paid out to the client for claim on long-term care are always tax-free. But it also allows for the possibility of a tax incentive in the form of either using it as a deduction, or you could use HSA funds to fund most or all of that premium. That's the way, just very simple blocking and tackling, that's the way that the products work. So what we're going to do now is turn the tables for just a minute. Let's look at this through the lens of the client. So why do clients buy these types of products? So the number one reason, as you can see on the left-hand side, is that they know there's a benefit paid no matter what the future holds. That's simply referred to as live, quit, or die. So the live feature is accelerating those benefits before they pass away. Die, meaning there is a death benefit. And then, of course, quit suggests that, yes, if they ask for their money back, they can get it back because they have cash value that are in the contracts. So that's why clients love these products to start with. But yet there's some other things that clients love about it too. Everyone loves guarantees. So you have guarantees built into these types of strategies. Guarantees in the forms of premiums that never go up, cash value growth, that death benefit I keep referring to, and cash surrender value as well. Now on the right-hand side, this is unique to One America. We have joint benefits. So simply put, a second to die policy structure. So two people on one contract. And we all know from Life Insurance 101, for the same amount of premium, 2 people on a policy will generate a higher death benefit as a second to die. Higher death benefit means more long-term care in this scenario. And the last one is lifetime benefits. You've heard me say that a couple of times now, and I'll say one last thing around that and move on. We don't have time today because we're trying to keep this a nice, short, condensed webinar in about 30 minutes, but I like to refer to long-term care planning as an income problem, not an asset protection problem. So if we can generate income for its intended purpose, in this case, extended health care, long-term care, and that income for that purpose in this bucket never, ever, ever ends, that's exactly what some of you do for your clients when they go to retire. You're creating income that never ends. At least that's the goal, right? Okay, so now let's talk about qualified funds. Now this stuff is really, really basic to say the least, but for consumers, what's the big deal? Why, qualified dollars? Well, because I mentioned before, we can put 2 people on one policy. And more important, we can use one person's qualified account to cover 2 people. And that becomes very important with couples where, and this happens a lot, where you have, one that maybe they worked, throughout their entire career and the other one stayed home with the children, or one was, more of a breadwinner than the other one, and they have a lot of qualified accounts. We can use that for both people. We can also use this strategy to help with those RMDs, meaning required minimum distributions, that we all face if we have a qualified account. And then if we can become efficient with the taxes and spread out that taxation and put a plan in place or a strategy in place, that's just gravy on top. And I'll show you how that works in a minute. Now let's be selfish for you for just a moment. For you as an advisor or an agent or producer, there are so many qualified accounts out there today in the form of those 401ks, 403bs, and IRAs. And also, it's a great way not only to generate more sales opportunities, I'll even say it'll set you apart from the rest, because very few people in our roles, meaning in the financial services roles, are talking about using qualified dollars for a long-term care plan. So let's give you some stats real quick. As of 2019, I mean, this is astronomical, right? And I'll joke for just a moment, and Allie, make sure you're on mute so you don't giggle. But, that old saying, why do people rob banks? Well, they rob banks because, that's where the money is, right? Well, guess what? That's where the money is here. I'm not suggesting you rob the bank. I'm just saying follow the money. That's what, is important to our clients. Well, that money in motion, much of it is in qualified accounts to the tune of $7.5 trillion and growing over time. And approximately a third of the US, or over 100 million people, are contributing to those types of accounts. All right, so now let's even dive further and talk about a couple of specifications on this product. Now, we call this product Asset Care, and the subtitle is Annuity Funding Whole Life. So it's still the Asset Care product line, Annuity Funding Whole Life. So how does that work? Remember back a couple of minutes ago, I said we have a base policy, which I'm highlighting on the left, and then we have a rider. So the base policy, as I mentioned, is funded with qualified money. You'll see how that works in just a moment. Now, we do highlight that we can, our target market is 59.5 to age 80. I will tell you, though, you can go down market there. You can go below 59.5. I'll show you a couple of ways that you can do that, especially under the Secure Act and with those inherited IRAs. There's a provision there that allows for no penalty at all. Again, we can do single cases, joint cases, and there's many different ways that we can accelerate the benefits for care. And then on the right-hand side, as you've heard me say now a number of times, they can get either a limited benefit or an unlimited benefit. Okay, let's put this into motion with numbers now. So what you're going to see me do is just explain just a quick case study type number, and I'm going to go over that just at the treetops level first, and then I'll actually put it on all on one slide and show you a real life example for a couple using the same numbers. So what we're doing here is we are transferring or rolling over from an existing qualified account. And what happens is that comes over to OneAmerica, and it lands in a deferred fixed interest annuity IRA. And we have an income rider on that fixed interest annuity IRA. But then what we do, which is kind of neat, and please take this down if you're taking notes, or maybe I've now grabbed your attention if you're multitasking. I know what we do on webinars, right? But if you're multitasking, please pay attention to this one. This is important. We give your client a 20% bonus day one after underwriting. So in this case, you'll see that the $150,000 that came over gets an extra $30,000 because of a 20% bonus. That means now we have $180,000 in my example to work with. And then what we do is we turn on an income rider for 10 years. And what you're going to start to see on the screen as I continue to click here is after year one, you'll see that number goes down by 18,000. Year two, another 18,000. Year three, another 18,000. And so on until we get to the last year, the 10th year, and now all of the qualified money is out of that account and into life insurance and long-term care benefits. So I'll highlight this now and I'll reiterate it in a moment. On the screen, you should see my spotlight hovering over the annual distribution amount. My example shows 18,000. That is a taxable distribution, which means that for 10 years in a row, $18,000 per year will be the number on the 1099 that we issue that the client would have to pay taxes on. I'm going to stop there because I want to drive this point home. Sometimes when we start to explain this, people start to either fog over or question, what are we doing here? Oh, I don't want to have my client pay taxes. But please understand, neither you, OneAmerica, or the client, they're not creating a taxable event that doesn't already exist, meaning that those dollars in the qualified account will be taxable at some time in the future anyway. It's just when, right? Whether they're forced to do so at RMDs or whether it's forced to do so because of an inherited IRA, or they just take the money out because they want to put a new roof on the house. It doesn't matter. They're going to pay taxes on that, income taxes. We're just now showing you a way that you can do that efficiently. So let me paint it even clearer now. Let's use the same numbers, and I'm going to review. But I'm going to put some color on it so that you can see a real life case. So we're going to use male 61 years old and female 60. Very, very common. Hundreds of thousands, millions of couples like that across the country. And they have a lot of qualified money in that 401k, 403b, existing or inherited IRA, and they transfer the same number over. Now, I'm using 150,000 just as an example. That number I've seen much, much higher, and of course, much, much lower. It just depends on what your client has to work with. So in this case, back to the basics, 150,000 comes over. Day one after underwriting, we got a 20% bonus tacked on. That equals $180,000. Now, we use this visual of the hourglass because, you know, when you flip over an hourglass, the sand that's at the top, that is, in this case, the qualified money. And the taxation becomes where the sand goes through the center of the hourglass, the distribution. So in this scenario, same thing, 180,000 divided by 10 because it's a 10-year income rider, $18,000 now pays for the life insurance death benefit and for the COB rider, that continuation of benefits rider. So what I'm building on the screen right now are the actual numbers. So you'll see that the $18,000 in this example breaks down to about $9,400 pays for the life insurance death benefit of $176,000. This is a real life case, meaning you could generate the quote today with this couple. And then we need about $8,500 a year for 10 years to pay for these wonderful unlimited benefits in the form of the rider. So that is a pretty easy thing to understand. Now, for those of you listening to this or seeing this for the first time, it'll take you a couple of times to really get it, to be understood. But you know what I'm going to do? I'm going to help you with, remember, it's all about the client here. We're just helping them with good tools, right? So if you're taking notes, please write these down, please. I call these the what if questions, because when you start showing clients, they will ask things like, well, hey, what if, so now let's fill in the blanks. The first question generally is, what if we never need care? So the quick answer there is, if they never need care, they're guaranteed, unless they surrender, most people don't, they're guaranteed the life insurance death benefit. Now keep in mind, life insurance death benefits are paid how? Tax-free to the named beneficiaries. And I stopped for a moment because I want you to think of the psychology of this. Now, Allie, I know you're on mute, but if you were to able to answer, you can cheat because I'm highlighting it. This couple transferred over $150,000. Worst case, they never need care. Upon death, their beneficiaries get $176,000 tax-free. Taxable, tax-free. That's the psychology of this. So now when you think about that, clients, their mind, the psychology of this is that they're still in the game, okay? They still like that. Okay, tell me more, right? So then the next question is, well, wait, what if we need some care? And what they're really asking there is, and I'll use an arbitrary number, let's say they only need $100,000 of benefits for their long-term care claim. Well, what's guaranteed is always that total death benefit. So what you do is you just subtract the $100,000 from that. So now we have about $76,000 in this example that's still left for their beneficiaries tax-free. That's the second question. The third one becomes really interesting because now you know they're thinking about this. They may say, well, what happens if we need a lot of care? And what I mean by a lot of care is if they need more than the life insurance death benefit for their long-term care. That's where it brings the value of the unlimited benefits. You can confidently sit in front of those clients and say, no matter how long and for which one of you, because this is a couple example, no matter how long and which one of you needs care, the benefits will never, ever end. That's the third one. Now, the fourth one is that I call it the escape hatch or the, or the exit door, which means that they decide, hey, what if I change my mind? Well, if they change their mind, what they'll have, because of insurance rules, they'll have the cash value that's left in the life policy, and they would have the balance in the qualified account that could be transferred out to wherever. Now, you understand this, but we're not going to give them the bonus, the remainder of the bonus, if they do surrender, but it would be whatever's left in that qualified account as far as the account value. The final one, this is like a little bonus question that they'll ask, is when they really get to thinking. And they're going to ask something along the lines of this. Well, wait, now I'm getting this. I'm starting to understand this. So this is a 10-year strategy, but wait, what if one of us needs care during the 10 years? Let's just use an arbitrary year, year 3, okay? Year 3, one of us needs care. What happens? How does that work? We have what's called built-in waiver of premium for long-term care. That means that we waive the premium due for that year for both the life policy and for the rider. So when we go back over here to what happens to the $18,000, well, that's the client's money, okay? That's not our money at One America. That's the client's money. We redirect that back to the client. I cannot overstate how important that is to a family when they initiate a long-term care claim. All right, let's summarize it for those of you that aren't visual learners like me, that like pictures and graphs. Let's summarize this in key points. You can use one person's qualified account for joint benefits. Next, we're going to tack on a 20% bonus here that gives them their total income base that we divide by 10. This is a 10-year strategy to pay for the life insurance that can be used for LTC and for the rider. Also, day one, all claim payments are tax-free. If some of you are used to how we, over the years, had our qualified product, it wasn't like this. We just enhanced this product last year, and that is a major, major change. All LTC claim payments are tax-free because we take it only out of the life insurance and then out of the rider. Then, as I mentioned, built-in waiver of premium, that's also new. So that's a great feature. And finally, we're helping with those taxes and spreading them out, but we're also helping because all of the distributions count towards RMD, those required minimum distributions, if they reach that age of 72. So we are truly helping in every single way. Now I'm going to show you quickly a couple of screenshots of what the ledger pages and the illustration would look like when you're ready to ask the core marketing group team for those illustrations. Same numbers, same couple. Here's what it would look like on the illustration for you to present to your client. So we have the distribution, which I've already described how that works, your death benefit called the face amount. Then you have that death benefit face amount that's payable for LTC. And if they chose that awesome sauce rider up to unlimited, you'll see graphically it shows you easy to understand and explain to your client. Next slide is a screenshot of the ledger page. And remember how I gave you those what if questions that you will be asked when you talk to your clients? You can confidently answer every single one of them right from this ledger page. What if we never need care? There's your death benefit. What if we need some care? There's your total benefit for care. What if we need a lot of care? There's your unlimited benefit over here. What if we change our mind? You've got your cash surrender value column. And then the last one is waiver of premium. If they need to file a long-term care claim, you can essentially say that those premiums stop depending on the year that it is and get redirected back to you. That's how waiver of premium works. And now I did promise you that I would wrap all this up in a bow as it relates to the Secure Act, and in particular, one provision within that Secure Act. And so one of the provisions is related to inherited IRAs for non-spouse beneficiaries. So in the past, so prior to the beginning of this year, what would happen is that if someone inherited an IRA, they would be able to, people have loosely called this a stretch IRA, which means that you could stretch those payments out over life expectancy of that beneficiary. Well, now what the government has said, because they want your tax dollars quicker, that they're going to condense that to no more than 10 years. So therefore, you have to get that money out in 10 years, which means that's added income to the beneficiary. So let me give you a real life example. Let's use Mary, all right? Mary is in her early to mid 50s, and mom and dad lived a great long life, into their early to mid 80s, just like normal, and then they passed away. Now mom and dad did pretty well for themselves, and Mary still is sitting on about $1 million of qualified accounts. So she's the beneficiary of $1 million IRA. Well, thank you, mom and dad. You worked really hard for that. But now what happens is over the next 10 years, now just divide that by 10. I know there's interest involved, but still divide it by 10. That's an extra $100,000 of income for 10 years straight that we have to tack on to her current income. Now, Mary, generally speaking, in her early to mid 50s is probably starting to get to those peak earning years, right? Which means she's probably pushing some of those tax brackets anyway. Now tack on another $100,000. What's that going to do to her tax bracket? Most likely even further increase that, paying more and more taxes. So we can't do anything about having to pay those taxes. What we can do is say, how can you take a portion of that and turn it into a personal benefit for Mary in this example? You can do that because remember how I said they require the payments to come out in 10 years? And then remember how I told you our strategy here for this product is a 10-year strategy? We did not know the provision was going to be a 10-year provision when we built this policy a couple of years ago. It fell into our lap. But, you know, when opportunity knocks, open the door, right? So this is our opportunity to use this solution to satisfy that provision and provide long-term care benefits. And so, you know, that is a pretty good idea. And, you know, you will get a few of those opportunities and sales to help your client with some of that. But I say there's even one better. Here's where I say it gets better. Why wait until Mary inherits in her mid to, you know, early 50s, somewhere in there? Why wait for that inheritance to happen and have that tax bomb? Why not have mom and dad, let's roll back the clock. Maybe we get to them when they're in their 60s or early 70s. They put some of their qualified accounts into this type of solution. And you know what? If they never need care, remember what I said the fallback position is? Now a tax-free, that's the key word here. Now Mary inherits a tax-free death benefit instead of a taxable IRA. And for that matter, a condensed taxable IRA, which would push her into a higher tax bracket. So when you look at it through that type of view, that means that this product, now it's not genius, it's not a magic wand, it's just this product alone can help you and your clients with a phenomenal estate planning approach. Estate planning, generational planning, tax planning, inheritance planning, fill in the gap. You can use this tool for just that. And remember what I said a few slides back. I mean, we have 7.5 trillion reasons to do this because there's that much opportunity that's right in front of our noses to help clients with this. All right. So with that, Allie, I finished just about 2 minutes after the bottom of the hour. So I think we nailed it on time. But what questions were typed in before we closed the webinar today?
You did great. Thank you so much. And I do like that idea that you mentioned at the end. So hopefully if anyone has any questions about that, you can always, if they're not coming up right now, but they come up in the future, you can always reach out to us. Reach out to your relationship manager. I know Brad's great at responding as well. So we appreciate you. I don't see any questions popping up at the moment, so we might just be able to wrap. But like I said, if something comes up, please don't hesitate. This recording will be available on the advisor resources page on our website. There's a webinar link to the recording, so you can watch this webinar or any others that we've done in the past. And Brad, I appreciate you so much. Thank you.
Oh, thank you to everyone that took time out of your day, and I appreciate the partnership with CORE. Everyone, have a great rest of your day.
Have a great one. Thanks.